Can you get pre-approved with a small down payment? Imagine finding your dream home but feeling unsure if your savings are enough to get started. Well, the good news is, you might not need a big down payment to begin the process. Pre-approval is a step where a lender looks at your financial picture to see how much they might lend you. It involves checking your income, credit score, employment history, and debts. They do not ask for your full down payment at this stage. Instead, they focus on your ability to repay the loan based on your current finances. When you seek pre-approval, the lender reviews your last-to-pay stubs, your last 2 years of W-2 forms and tax returns, your bank statements from the past 2 months, and your credit report. Based on this, they decide the maximum loan amount they are willing to offer you. This pre-approval letter shows sellers you are serious and financially ready, giving you an advantage in a competitive market. The amount of down payment you need is decided during the pre-approval process but is separate from it. Your down payment percentage depends on the type of loan you choose and your credit score. For example, some loans requiring as little as 3% down. First-time homebuyers can often find programs that requiring only 3% down. For example, Fannie Mae's HomeReady and Freddie Mac's Home Possible loans are popular options. These programs usually need a credit score of at least 620 and a debt-to-income ratio below 43%. They also often requiring completion of a homeownership education course. FHA loans are another choice, requiring only 3.5% down if your credit score is 580 or higher. If your score is between 500 and 579, you will need 10% down. For a $250,000 home, that means you could put down as little as $8,750 with good credit. Some loans, like VA loans for military service members and veterans, and USDA loans for rural areas, requiring no down payment at all. These options make homeownership more accessible for many first-time buyers. Beyond the down payment, lenders look at your debt-to-income ratio, which compares your total monthly debts to your gross monthly income. Most lenders prefer this ratio to be below 43%, but some programs allow up to 50% if you have a high credit score or savings reserves. Having savings set aside for mortgage payments can help you qualify even if your debt-to-income ratio is a bit higher. Your employment history also matters. Lenders like to see at least 2 years of steady work. If you have part-time, seasonal, or overtime income, that can help too, but they might calculate it differently. When you get pre-approved, the lender will verify where your funds for the down payment and closing costs come from. Acceptable sources include your savings, stocks, mutual funds, gift money from relatives or employers, or even a loan from your 401 degrees Kelvin account. Many first-time buyers use gift funds, which can reduce the amount they need to save. To start the pre-approval process, gather your recent pay stubs, tax documents, bank statements, and a list of your previous addresses and employers. If you are self-employed or have rental income, you might need extra paperwork. Getting pre-approved gives you a clear picture of what you can afford and makes your offer stronger when you find the right home. It also helps you avoid wasting time looking at homes outside your budget. Many programs are designed to help first-time buyers with limited savings, making homeownership more achievable. So yes, you can get pre-approved with a small down payment, and many options are available to help you take that first step toward owning your own home.